Go.
Bam.
All right. Good morning, folks. Thank you very much for joining us here at the daily presentation today with Portfolio Builder. My name is Dean Gallagher. I'm an investment consultant and a partner here with Portfolio Builder. I wanted to thank you for coming in on the 13th here of January. And just thank you for taking the time to join our daily webinar. Please enjoy the education and ask questions along the way. Okay, we truly appreciate your time and attention to show you how boring successful trading can actually be when you have the right strategy. Okay, wanted to let you know many of our members make more than the cost of the membership during their trial, and the trading plan takes less than 2 minutes to execute at noon Eastern daily. Okay, I'm going to go ahead and put my number up on the screen here, guys. Please feel free to save it in your cell phone number or write it down and just tape it to your computer. But my number is 505-322-7515. You can call me with any questions you have under the sun about the system, or simply ask them in real time during the presentation. Okay, but important to save that number. Love to talk about the markets. Definitely obsessed with the financial markets, the financial system, how everything works and why. So would love to chat about anything you have in regards to the markets or what we do here. Okay, folks, I really want to reiterate, the core basis of our methodology is going to be based around the top investor of all times, number 1 and number 2 rules. Okay, rule number 1, never lose money. Rule number 2, don't forget rule number 1. Okay. This rule has proved to just be so incredibly important and helpful for me. And this system is going to show you how to reinforce that, put you in a scenario where you're never going to be worried about breaking rule number 1. Okay. The coolest thing about this system, folks, is you're going to quickly establish a hyper defensive portfolio. Okay. Plus, you'll eliminate business risk by owning a stake in 1,500 plus companies with just 4 ETFs. Okay. And folks, we're not just going to own 1,500 random companies. We are literally going to own the 1,500 best publicly traded companies on the planet, bar none. Okay. Trade alerts will be sent out via text message and email Monday through Friday. We engineer our positioning in coordination with the financial system and macro environment. Okay. So this is our daily presentation, folks. You can access the live presentation from our trade alert email we send out each day. Simply click the image that looks like a play button. Please ask any questions to the live during the presentation. Just click on the icon to unmute your microphone or simply use the chat box. Okay. And remember, you can always review our track record. Folks, we build trust by just being completely transparent with every position we've ever had. Okay, you can always access our track record right here, or you can always just go to Portfolio Builder, scroll to the bottom of the portfoliobuilder.io, scroll to the bottom of the screen and click track record. That'll take you there as well. A few things that you're going to need to get the most value out of your trial. Number 1, a brokerage account set up to follow our trading plan that has options trading enabled. You can use real capital or simply paper trade. Then you can see how incredibly easy it is to give your hard-earned money the protection it deserves. Okay, number 2, you're going to need the ability to take 1 to 2 minutes to follow our trade alerts. After a week or two, it's probably going to take you more like 30 seconds, but for the first week or two, it may take you a minute or two. Okay, these trade alerts are released at noon Eastern. These trade alerts are by no means time sensitive at all. They simply need to be placed before the end of the market close at 4 p.m. So you can have a window from 12 Eastern to 4 Eastern to get that trade alert in each day. If you get the trade alert and you don't have time to place it during that trading day, just wait till the next one to come out. Don't try to replicate it after the trading day is over. Okay. And let's see here. Number 3, you're going to need a mobile phone to receive our text message trade alerts. Many of our clients take these trades on the go from the airport, restaurant, in the car, anywhere you have service. It's important to make sure you enter your cell phone number when you sign up for the trial. If you use the landline, please email the cell phone number to ryan@portfoliobuilder.io, and we'll make sure to add the correct number to our distribution list. I absolutely love the text message. I trade from them religiously, and it's just so easy for me to check the text and replicate everything on my mobile trading account and go back to my day. Okay, number 4, you need an email provider that's in good working order. Okay, we will send out free daily webinar invites via email, and we also send out the trade alerts via email on top of the text message. Okay, current asset allocation for $300,000. We're going to be 50% in the top equities on the planet. 40% is going to be risk off in bonds. 10% is going to be risk off in gold as well. Great way to balance your portfolio. Okay. Our target income is $3,930 a month per $300,000 invested behind the system. And that's going to basically look like 400 shares of SPY, 800 shares of EEM. And that's going to be your risk on. Risk off is going to be 800 shares of TLT, 800 shares of GDX. Okay. To make life easy, just remember for every 100 shares of the SPY, you want to double your shares of EM, TLT, and GDX. All right. If you didn't get today's trade alert, please email Ryan at portfoliobuilder.io right now, or chat with them live. Just click chat, and to do that, folks, just scroll down right where it says hover your mouse here to find a chat button or unmute your microphone. Just hover your mouse right there, okay, guys, and you will definitely find that. All right. And with that, Jason, I'm going to go ahead and hand it back to you and let you get started here.
Thank you very much. Excellent intro. And I hope you guys put that trade on quickly this morning. We're already up some 60 cents a share. And to summarize, we are bullish on equities in 2020, bearish on bonds, and also bullish on emerging markets and gold. We'll take a look at the analysis. First of all, let's just review our positions. And today we sold the 330 call option, and we purchased the 324 put. So we only collected a measly 11 cents on the 330 call, almost not worth selling. And we spent 29 cents for crash insurance. And again, there is a tremendous amount of option selling at that 330 level. So it'll be very tough for the SPY to break beyond that, at least in the short term. So that's why we did choose that strike. In terms of the put, we balanced it so we have an equal risk to reward ratio today of $300 in either direction. So the worst case scenario, let's say China turns around, decides not to sign the trade deal, highly unlikely, and SPY crashes $10, $20, $30. It won't matter because you own the 324 put option. Now on the other side of the trade, let's say the SPY miraculously does trade above 330 by Wednesday on trade optimism. Well, we give up profits after we go above 330. So that's just a summary of the risk reward going into this current trade. Let's talk about how to get out of the previous trade. We do scroll to the very bottom. You get two screenshots. Here's how you close out last Friday's trade, which was a bearish inverted option caller. We sold the 326, which was in the money, and we bought the 327, which was also in the money. Now, depending on how quickly you reacted to today's trade, you made a couple pennies. Not a big deal. It was a precautious trade as the Fed's balance sheet dropped $25 billion on Friday after its growth had slowed down the previous Friday, averaging $25 billion a week of balance sheet growth, dropping to $10 billion 2 weeks ago, and then reducing by $25 billion last Friday. My expectation this Friday is it will grow rapidly, and you'll see once we do look at the analysis. The trade is to sell to open the 330 call and to buy to open the 324 put. If you're coming in a little late, the trade's already moving in our favor, but we have a lot of upside potential on this. We're trying to capture about $3 per share, which is a unusual profit for the SPY for us. But we have the right catalyst to make that happen this week. Let's go back up and review the accounting of the previous trade. And again, if you do have any questions, please go ahead and post to the chat. Again, we were bearish from Friday through Monday for a very short period of time, simply to see how the market would react to the Fed dropping its balance sheet by $25 billion. That's a big decrease. And again, I do suspect it will rapidly grow this week when we look at the debt issuance scheduled on the front end of the Treasury curve, which is what the Fed is currently allowing itself to pick up. The SPY traded from 326.96 to 326.80 for a decline of 16 cents. The option started off with a credit of 72 cents, and we paid 47 cents back to close out that option cost. The net gain was 9 cents, not 90 cents. My apologies on the zero there, and we gained $171. Basically a flat trade for us. We do look at our return. We're up 0.2% in January. However, that should spike higher as the TLT pulls back and stocks rally ahead of the good news this month, or rather this week. So I do expect we can see our TLT position push us up towards a 0.6% return profit this week alone. Add in some profits on emerging markets in the SPY. We might just crack that 1% return in January, which is my target goal. I love that Dean pushes me to aim for a little higher with 1.25 advertised in the intro, which is what our average has been to date. Looking at open positions, we're long emerging markets. And again, we're not just long equities or any other ETF. We always have downside protection. And again, the goal of this program is to create return with low volatility. That means we have to be very accurate in predicting the movements of these different asset classes because we're always fighting against the downside protection that allows us to generate this low volatility return. Emerging markets was trading at 46.06 when I took the screenshots this morning. I do anticipate it's much further currently, but at that point in time, we'd paid off the option cost for the week, which was 30 cents, had a value of 3, returning a negative 27 cents per share from the put option protection to the downside, leaving us with a gain of 92 cents a share on emerging markets. TLT position, you should most likely be assigned currently. The math on the assignment was we sold the 133 call, which was a deep in the money call option, covered call in the TLT. The net profit on that portion of the trade was 22 cents and left you wide open with a long put. The put was down this morning. We paid $2.26 initially, and it expires Friday. Currently, its value is 85 cents. However, I do expect the TLT to drop and the SPY to rise this week, which means we'll be gaining profits in both directions. GDX is down 9 cents a share, trading from 28.12 to 28.03, down 9 cents. And again, we bought a 2-month duration put option that was in the money. This means we recognized the maximum loss the second we put this trade on last Thursday, and we're trying to pay off this put option before we go into the green. So we need GDX to go up approximately $1.59 before we've paid off our downside protection and then can start enjoying profits. Now, that's a 2.5% maximum loss, which we realized the second we placed the trade. And my anticipation is a potential 10 to 30% run up on gold by the time our option expires February 28th. So that's a nice risk to reward ratio. And considering the problem the government has with too much debt and that the Fed's having to purchase this debt, I do expect gold to rise. Now, let me see what questions we have out there. Oh, yeah, I did see that. The currency manipulation. Yeah, so we still don't know what on earth's in this trade deal coming out Wednesday. And now they're calling it a fact sheet, so almost comical. Okay, so that's a review of the trade. I do want to play my analysis video next, then do some Q&A, and then we'll go look at some of the top news.
And so, folks, just kind of a quick heads up here. Jason's going to go ahead and record a substantial amount of information every morning, and then he's going to play it live here in our daily update. So, just a quick little tidbit on what we do to do the production, but it's hours that basically goes into this. So, please enjoy.
Okay, one moment. I think we're having, let me get the sound going here. Portfolio Builder members, welcome to our Monday trade alert on the SPY ETF. Today we're placing a bullish trade ahead of a US-China trade deal being signed. Over the weekend, we played it safe with a bet that could lose up to 30 cents if the market traveled higher and win as much as 70 cents per share if the market were to travel lower. So this was what we call the inverted option caller. We benefit if the trade is closed out below 327 and hit our maximum profit after 326. It was a low risk trade. And the main reason we played one bet to the downside over the weekend was in case the $25 billion reduction in the Fed's balance sheet would cause some fear. My read on this is that the Fed is highly confident the market can hold its own this week ahead of the US-China trade deal being signed on Wednesday. Other headline risks would include the Iran situation getting more aggressive. The impeachment is now pushing to the Senate most likely this week. And plus we have earnings coming out, so there will be a little bit less of the corporate buyback helping keep stocks afloat. So I'll be closing out this trade at 9:30 my time, which is 11:30 Eastern, and we'll see where we land. The SPY's been toggling back and forth between 326 and 327 all morning. Now again, our outlook for the markets in 2020 is for the SPY to rally towards 360, which is considerably higher from here, and for the bond market to really have a serious sell-off, which means the TLT could crash to as low as 120. Now, here's a look at the TLT ETF. Most of you were likely assigned, which is exactly what we want, and creates the opportunity for a double payday, just like we had last week. If you were assigned, you're now in cash and have a profit from being assigned on the long side of our trade. You'll remain with a long put option, which is gaining value as we speak. So this is exactly what we were hoping would happen this week, is a sharp rally in stocks and a sell-off in the TLT. So we'll see if this continues to play out. If we do look at the big picture on the TLT, we can see in the long run, it can have some very vicious sell-offs. And so if we look at the scare in 2015 that drove bond yields lower after the China slowdown was fixed with some more infrastructure spending and massive stimulus, we saw that the bond yields spiked, causing the TLT to tank right over here in 2015. Same thing happened in 2017, and I believe the exact same thing is going to happen in 2020. Now, the amount of debt outstanding has grown substantially since 2015, which means these yields can't get too expensive before they will cause severe pain to the stock market. So once again, I'm only looking to short the TLT until 120 range, where I think we will see this crack the stock market, force the Fed to go into a new series of rate cuts, and the timing of this should be right around the election. So this will be an exciting time. And again, we can make a lot of profit betting down on the TLT during this period of time. After that, I do believe the TLT will go into a massive rally into 2021, with the big headline being China Trade War 2.0, as we realize that the deal we're signing this week is really just an agricultural purchase that they may very well not be able to keep up their half of the bargain. So realistically, this is more of a truce, which is causing the scare in the bond market to be removed, that we won't have growth in 2020 as all the big central banks are in a period of quantitative easing, which is, again, another risk factor we have to closely monitor, as we do want to see the balance sheet stay strong. And by strong, I simply mean remain elevated and slowly grow. Current growth rate is $100 billion a month. So If we go back 2 weeks, it did drop $10 billion in terms of growth per week. And so it only gained 10 billion versus the normal 20 to 25. Last week, they pulled back $25 billion. So that is alarming and something we need to pay close attention to in the weeks ahead, is that this needs to at least flatline and hopefully begin growing again, which is going to be fueled by one key indicator, which we'll take a look at in a minute. Now in this chart, I have emerging markets, which is rocketing higher ever since the phase one trade deal. Keep in mind, emerging markets is trading at a PE multiple much lower than U.S. stocks, with U.S. stocks at 18.6, just around the same PE multiple we had in the 2008 realm, far lower than the 26 PE multiple in the dot-com bubble. Emerging markets are a bargain, and without the pressure from U.S. Really clamping down on China, you can see why this stock could very well, or rather ETF could very well outperform the SPY in the months ahead. Our target is to at least get to that $52 price point we saw in 2018, and most likely substantially higher. Now this is what we'll be trading tomorrow on Tuesday. And again, my expectation is a very bullish bet on emerging markets. Currently, this is our position that has the largest percentage gain week over week in the entire portfolio. Now, the final core position in our portfolio is GDX. That's the gold miner ETF. And we're playing the quantitative easing effect, which we can see back in 2009. We had a very similar setup. We had the fear of a recession in 2008, where the Fed cut interest rates all the way to zero. And after accomplishing that, they went into a period of quantitative easing while remaining rates at ultra low levels. And so this had the effect of boosting asset prices. And we can see that stocks and gold miner stocks went up together while this period of quantitative easing was in full effect. So that was from 2009 through 2011, and drove GDX from a value of 16 to as high as 62. Now, my expectation is we can blow past that price point, but it all lines up with the quantitative easing and getting rates even lower. My expectation is in 2020, we have a good profit on GDX from quantitative easing, but we won't see the real fireworks until 2021 as the Fed goes into the final period of rate cuts to zero, and then into what they call real quantitative easing, where they're not just buying the front end of the Treasury curve, they start buying the notes and the bonds. So that's my expectation. If it starts to happen sooner, then of course we could be seeing all these predictions play out far quicker. On the other hand, if the Fed keeps rates flat and continues to allow their balance sheet to roll off and reduce in size, there could be some severe downside risks in GDX. So that's why in this position, we've purchased the 2-month put option that was in the money. This means we locked in a maximum loss of 2.5% on this position and have to work that off before we realize any gains. So we do need GDX to appreciate between now and February 28th by over 2.5% to recognize the profit. Now, the potential return on this during that period is anywhere from 10 to 30%. So it's a great bet. We risk 2.5% to earn 10 to 30%. Now, this is only 10% of the total portfolio, and it's actually a bit less than that. So it is a little bit under that 10% setup when we have 200 shares. My expectation is this will rally into the year and get closer to that 10% target without us adjusting the 2-to-1 ratio, where we have 100 shares of the SPY and 200 shares of GDX. Okay, so the next thing I like to do before committing to our long-term bet on the SPY and TLT is make sure that the core strategy that's kept the stocks ahead remains intact, which is corporate buybacks. And so there's really 3 core ETFs that do represent the bulk of the investment in this space. The largest by far is AGG, The higher this is, the lower it costs for corporations to borrow and buy back their own stocks. And they're borrowing at record pace as we speak. This trend remains intact, so no worries on AGG. Now, LQD is perhaps even more important because it represents the investment grade. And most of the gains in the S&P 500 have been delivered by a couple companies, namely Microsoft and Apple. So with this at all-time highs, there's no risk that your top dogs in the SPY ETF won't continue to borrow and buy back their own stocks. Now, what could turn this situation quickly? Well, that would be if earnings started to disappoint. That's going to be awfully hard when the government is creating massive deficits that's flowing straight into these corporations. So it's coming at the cost of the U.S. deficit growing, which we'll take a look at in a moment. Meanwhile, HYG can be another leading indicator. It's not at record highs like it was in 2013 and 14, but it is at accommodative levels, which allows your Russell 2000 companies to still get plenty of debt to grow their companies and, again, buy back their stocks. So if we start to see this fail, it could be a warning sign that there's trouble ahead in the credit markets and thus for stocks. Now, on Monday, I also like to take a look at three other stock markets: the Brazilian market, the Mexican market, and the Canadian market. And we've really seen a trend where Brazil can be used as a leading indicator for U.S. stocks. And that is in the yellow line, and it's pointing right up, indicating that we do have a clear sign ahead for a bullish stock market. If I zoom out, we can see the bigger trend. And I'm going to go ahead and remove a few of these. And we can see that when the yellow line dips shortly thereafter, and sometimes there is a lag, we're seeing some serious sell-offs in U.S. equities. So that is a great leading indicator for us. And again, so far, no problems when we do look at the more recent data. Now, it did sell off a little bit earlier in the previous week, and we did see a little sell-off at the end of last week. So it's doing its job from that respect. Currently, it is pointing up. The next chart I like to look at today is DXY, which is a dollar currency index. And the big theme we need to see here is a weakening dollar. Without a weakening dollar, our gold position is going to have trouble, as well as emerging markets. And without emerging markets performing, the whole global growth recovery is going to be short-lived. So it's really critical to see this slowly but surely devalue into 2020, just like we saw in 2017. And that's where we had a very bullish emerging markets. Now, if we zoom in, we can look at closer trend, and sure enough, with stocks rallying in the futures market overnight and starting to recover from the sell-off on Friday, we see the correlation we would expect with the dollar weakening. Now in this chart, we compare the dollar index against a number of other US dollar pairs. And you can see over the past decade, the big trend was for other currencies to significantly devalue against the dollar. We're seeing devaluations anywhere from as little as 10% in China to as much as 50% over in Mexico, with the median being around 30%. And if you do look at what's happening in the most recent period of time, these currencies are starting to strengthen against the dollar, and this is really across the board. So this is, again, lining up exactly with what we would expect for all of our trading strategies going into 2020. So what's the driver of all of this? The driver of all of this is the U.S. government creating more debt than it can pay for from its tax receipts, or otherwise it's spending more than it makes. And so in this, we can see the week ahead of upcoming Treasury auctions. Now, unfortunately for our TLT position, there's no big Treasury auction selling long-term 20-year, 30-year debt. However, there is a massive load hitting the front end of the Treasury, which will most likely expand the U.S. Federal Reserve's balance sheet, where they are currently buying up treasuries like it's nothing else. So we have $78 billion of T-bills hitting, which are the 13-week and 26-week debt instruments. Now, this is going to most likely cause a big jump in the Fed's balance sheet at the end of the week. It'll be interesting to see just how much it grows considering this massive amount of debt being sold. Next, I'd like to take a look at the balance sheets of these same three stock markets central banks, and this is the Brazilian central bank. You can see it's flatlined. It had been growing for the past 5 years, and it's really flatlined. The Canadian central bank has grown in 2019, but slowly selling off a little bit into early 2020. And the Mexican central bank is clearly allowing some of their balance sheet to reduce, which is probably what's causing its currency to strengthen so quickly against the US dollar after having lost half its value in the last 5 years alone. Portfolio Builder members, welcome to our... Okay, guys, so that's a good look at the charts. Now, I do want to make a few points about some of the news. But first, let's see if we have any questions out there. I'm very happy we got that stream without issues today, so that's great. Okay, so top news. We're starting to see a Twitter fight between Michael Bloomberg and Donald Trump. So they're going at it. We have the impeachment headed to the Senate most likely this week. And those are really the core risks. In Iran, we are seeing massive protests. Trump was tweeting over the weekend that there better not be bloodshed, that we don't need another Tiananmen Square. At least he hinted at that. He didn't say those exact words, which was most likely not too happy for, not a great comment for the Chinese to be reading ahead of their signing this week. And then apparently they've removed the currency manipulator designation ahead of the trade deal, which is funny because if the Chinese really opened up their currency and did allow it to have a free market, my expectation is this would devalue to well above 10 yuan per dollar, currently trading around 7. So in our boot camp, this is a currency we're dying to short, but we don't want to do that until there's a catalyst. And now I'm expecting this catalyst to be revived somewhere around the election or shortly thereafter, as I do expect trade war 2.0 to be the big headline going into 2021 and to give the ammunition for the Fed to lower interest rates and go into real QE, which it really needs to do regardless of a trade war, but that will give it a good excuse to publicize in America. Okay, so that is a wrap on the new content for today. Let's see what questions we have out there. I'll go ahead and unmute the crowd. And some shout outs to some of our favorite members, Murray, Karen, Gary, Bob. We got a bunch of you guys on there. I think I saw Scotty on there. Scott, how's it going? What's on the top of everyone's mind today? Oscar, how's it going? See you're in there as well. William?
Hi, Jason. Question.
Yes, sir.
Most markets top out on absolute euphoria, and this being options X week, would you consider this extreme euphoria?
No, I think we're gonna go much higher. I think we're gonna go much higher. We have low interest. The fuel is really what I'm worried about is when foreign investors start to take up most of the U.S. debt. Because right now the big picture is we have a guaranteed amount of debt that America simply cannot pay for. That must be sold. And so our primary dealers by law must purchase this debt. The primary dealers run out of cash. That's your JP Morgan, your Goldman Sachs, all the big banks. If they run out of cash, then the entire financial system freezes up. And that's what has caused the Fed to go into quantitative easing. And if we have a period of quantitative easing, I definitely don't want to be betting against stock market growth. So yeah, I think of the 1999 euphoria. That's the sort of euphoria that I'm thinking is coming our way. And also, it's hard to get bad earnings when you're creating more debt. So America's basically just maxing out its credit card in the bond market, and that's making corporations look like knights in shining armor. So yeah, I think that we're going to see a sharp move to the upside in the stock market and a sharp rise in yields. And that rise in yields will be what slows us down and eventually causes a reversal. So unless we think the government's going to stop spending so much money, we're really trapped. There's not really much we can do to avoid this situation. And to think about the potential, 1999 PE multiples rose to 26. We're only at 18.6 right now.
Right.
Which is ludicrous. So it just gives you a feeling for how parabolic this could go to the upside. Also, we've got $16 trillion sitting in negative yielding debt. And as these yields rise, that's going to put a lot of pressure for it to escape really complete nonsense in terms of buying negative yielding debt. So only thing that would change my mind is if the Fed stopped increasing its balance sheet. But you can see they loading up the front end of the debt issuance because that's what they're willing to currently put on their books. So I would expect a massive jump in the balance sheet Friday.
628.
Let's see, where are we trading at right now on the SPY?
Bought this for
327.32. So yep. TLT selling off, so that's good for our put. Now, did anyone get assigned on the TLT? Or are you still holding that?
Still got mine.
You still got
Me
yours?
too.
Okay.
Same here.
Okay, good. Well, did anyone get assigned? If the feedback is that we're all still along the TLT, I will do the reporting each day that we're not assigned. Although, as you saw last Thursday, the difference was only about 10 cents.
Okay, cool. And Mark wrote in, Mark Stoley wrote in saying he's still holding as well.
Okay.
And then Mark also wanted to, he said, happy Monday. Please explain in more detail how the assignment process works. As I was assigned, but I've also learned from you that not everyone will necessarily be.
Sure. So option assignment happens overnight and it's a lottery. So just because one of our members is assigned doesn't mean everyone will. And our setup is typically a covered call setup. So when you are exercised, you'll end up in cash and you'll just be long your put option. So if we're betting down on an asset, it can actually work in our favor to be assigned early on, like a day or two after we've issued the trade. And then for that asset to plunge because we're just long our put option. So I'll actually pull up the last time this did happen exactly in that manner on the TLT. So we can just see a real life example. So in the previous trade, we had two outcomes for how to close a position, which you can see here. If you were assigned, you only had to sell your put option last Thursday, which we generated a profit on. and you were in cash on the long TLT shares and your short call option. So those were taken away from you and generated a small profit.
History.
Now, if you were not assigned, you simply had to close out your short call for a profit and to close out your put. So if there is a chance that people were assigned on Thursday, I provide the visual for both. But let's just walk through the previous trade so we can see the terminology and language so that we're all easily following the commentary.
Okay, so we got the put.
So here was the previous trade. Let's zoom in on that. Okay, so we can see in this example, the TLT was trading at the last trading price right here at 137.12. And we collected $2.50 right here in the mid by selling the in the money 135 call. So essentially we're agreeing to a $2.12 loss on the TLT in exchange for a $2.50 credit for selling that call option. And so if we are exercised, then all we have to do is look at the loss on the TLT versus the profit on the call option. And so you can see there's a built-in profit, at least on that half of the trade, of 38 cents per share. So again, that's just subtracting the loss on the TLT against the profit from the call option. And if that happens, you're still going to own your put option. So that is something that can work in our favor, especially if the TLT really tanks to the downside viciously. Now, if it's just going to sell off to around that 135 call, that's where we're going to share about the same return, whether we're assigned or not. So is that kind of, so I guess a better question would be, what would cause someone to exercise their right and to force us into assignment? So if we buy this call option, or rather sell it for $2.50, the call option buyer is going to be sitting on that call option waiting for it to go up. So if TLT goes up and they're showing a big profit, they're going to sell their call option, and that in turn is going to create option assignment. Now, overnight, the option market will use a lottery to pick who gets to be assigned, and then you go into cash. So in our setup, nothing to fear about option assignment. You end up in cash, and you'll just be long your put option. And so if we were doing the opposite of the strategy, where we're selling put options, it's a whole different ballgame, because then you wake up one day and your cash has been converted into the TLT, and now you got to worry about what's the value of the TLT, because you'd only be assigned if you were losing. So it's really a safe way to play the option market the way we do, because we're using covered calls to sell options, and then we're buying downside protection with puts. So this is the exact trade setup we'll be doing on the TLT, like clockwork, almost regardless of any noise in the market. So unless there's something extremely significant happening in the tensions in Iran, if the China deal collapses, or if the Fed just stops purchasing debt, those would be probably the only three things that would change the course of our inverted option callers on the TLT. Now, in terms of how aggressive we get with this trade, I think we can look at the weekly auctions. And when we do see they're unloading big positions on the 20 and 30-year treasury, that'll probably be the catalyst that can really push those yields higher and really make this trade play in our favor. But just a tremendous amount of pressure in the bond market right now for yields to rise as the Fed remains flat. Now, if the Fed wants to start cutting interest rates, that again would be a reason to not be bearish on the TLT. But currently, they have no intentions of lowering interest rates. and there's just a massive load of debt. So the supply is tremendous, the demand is limited. In fact, the demand is so limited that the Fed's currently picking up some 80% of US debt that's being issued. So that just gives you a feeling for how much of a problem the US has currently to sell all this debt. Now, as those yields rise, it's going to become more and more attractive to foreign investment and start putting less pressure on the Fed to grow its balance sheet, less pressure on the primary dealers to buy up all this debt. So I do suspect that we'll see yields slow down in terms of rising, and growth will slow down tremendously as these yields get more attractive. Any other questions out there? We got 20 people live. Thank you all for joining us. It'll be very interesting to see what on earth's in this China trade deal being, now it's a fact sheet, whatever that means. So we got that coming out this week. We got the impeachment. We'll see what happens in Iran. They admitted to shooting down their own students. We've got massive protests out there. Hong Kong, there's videos of people who are unconscious getting thrown out of windows, supposedly as suicides. So that's an interesting common theme I'm seeing with US geopolitical strategy, as we seem to be taking advantage of dictators by creating protests and then streaming it for the world to watch. And it's handicapping how aggressive these different competitors to the US can be with foreign policy. So that's something we're seeing happen all over the world, really. So very interesting trend I'm following. All right, guys, well, I'll do a quick wrap up on our strategy. Again, our goal is to safely grow wealth. We've generated 16.82% return in 13 months, starting in the Christmas massacre mid-month in 2018. Biggest loss was in July, -1%. In fact, that was the only losing month. And I was protecting our portfolio against trade war escalation, which didn't happen in July, but it did happen in August. It's been back and forth for the better part of several years ever since Trump came into office. My expectation is with the elections that we will see less chaos from the administration, which should serve for bond market to sell off and stocks to rally into the election. Another key risk is actually Bernie Sanders is growing in popularity at a rapid pace right now. And a lot of his policies could be devastating to stocks and bonds. So these remain some of our core risks. Got Bloomberg, the 5th richest person in the US, aggressively campaigning against Trump. So we'll see how that plays out. In terms of our strategy, we're trying to achieve a 1% return per month. Sometimes we've done slightly better. There's periods of time where I'll play it safe. For example, from September through December, we played it relatively safe to make sure this Chinese trade deal would really be signed. And so far, it does look like the Chinese want some relief from all the tensions America's placed on it. So I do think this will reignite after the election, and we'll be back to trade war 2.0 with China. Any questions out there before we wrap it up? We do have a Q&A webinar starting in 1 hour for our bootcamp members. And Tuesday, we're going to be releasing the next module, which is learning how to place our trades. So that's a relatively simple module, but if you want to learn how to paper trade from the Thinkorswim phone app, that's a great way to get started with the program if you're just beginning, and also a good way to show you how easily you can place these trades on your phone. However, we'll also just look at all the different types of strategies we use with the option market, from the option caller to the married put, really our 2 core strategies. All right, little music.
Sounds like Dean's practicing his sax.
I have a question.
Please.
Yeah, so I see that there's a boot camp Q&A today.
Yes,
and
sir.
then also there's another one tomorrow for the it's like module 4.
Yes, sir.
I cannot find a link that gets me to enter the boot camp. I mean, I see the link for the boot camp page where there's modules and lessons, but not for the live event.
Okay, so you'll get that link in about 3 minutes right before, as that's a link created by Zoom, the webinar platform. So we actually can't get you that link before it is generated. So that'll hit your email in a couple minutes.
Okay, and that'll be the same for tomorrow. It'll be sent out that day.
Yeah, Zoom sends out your link 1 hour prior to the webinar starting.
Okay.
And so yeah, there's just no way we can have that link for you before that.
And then that comes from Portfolio Builder, or that comes from Zoom? Who's the sender on that?
The from email is support@portfoliobuilder.io, but it is sent from their server.
Okay.
But yeah, it still comes from the same email. The recording will get sent out several hours later, and we'll have a recap of everything important covered for those of you who can't make it live.
I just got the email right now.
Well, hey, technology is working. That's always a good thing.
Nice. Nice, Mark.
Right.
I was just going to say it should be hitting any minute here. So.
Yep, just got it. Thank you.
Perfect.
Excellent. All right. Did you have anything else, Dean, before I prepare for the next webinar?
No, I think we're good. Let's see here. Ron Steger, William, Zane, Abe, William, any questions here, guys? I know some of you guys are a bit newer, so just love to hear any last questions, comments, concerns, anything at all from you guys. And don't be afraid to be shy, guys. The more questions you ask, the more value you're going to get out of the presentation today. I know we cover so much in such a short period, but please feel free to jump in, ask any questions you have.
Okay, great. Well, we had a nice turnout today. I want to thank everyone. And again, if you do want to replay this, go back to your email, click the same link. It'll replay for you.
I have one last question.
Oh, good.
Just out of curiosity, this week we're going to get all this update on everybody's earnings for Christmas. Do you think that's going to make an impact on any of this?
Yeah, I do think earnings need to at least slowly grow. But you know, if the government is expanding its line of credit through its you know, you can expect that. Where's all the money going to go? Obviously, people take the money and go spend it, and it goes right back to these corporations. So I do suspect that so long as the Fed grows its balance sheet, earnings will grow as well, and keep this bubble bubbling up here.
Keep on keeping on. Okay, thanks.
Yep, spin, spin, spin. Good old government there.
Yeah.
Okay, well, great. We'll see you guys in an hour. Thank you so much. Appreciate everyone. And I'm glad I got that video to stream. I did notice that it didn't have the ticker up top or the dates below, so I'll try to fix that. But we did get the streaming issue fixed, so that's really good, as it does allow me to get a lot more content in a shorter period of time to you guys. And I appreciate everyone. Thank you so much. We'll see you in an hour if you're in the boot camp, or tomorrow if you're just in the advisory. So thank you so much.
All right, folks, thank you very much. And if you are just on the service and you want to do the upgrade to the boot camp, give me a call, 505-322-7515. Be happy to get that done before the boot camp starts today.
Thank you.